Okay, folks. Well, now we've got my friend John Embry. We've been paying attention to this stuff since the 1970s. And our good friend Murray Pollitt, who's in gold heaven, is looking down on us today, John. I'm going to hand it over to you. John's bio is there. I'm not going to go through that, and look forward to John's remarks and really the question period afterwards. Thank you, John.
Thanks. Thanks very much, John. I'm one of the few guys in the room older than he is, so I've got to take that into account. Good morning. It's a real pleasure to speak to you this morning on a topic that's very dear to my heart. The topic of my address today is the true fundamental value of gold. However, because gold is the arch enemy of pure fiat currency, I think it is first necessary to explore the recent history of the world's latest experiment with totally unbacked paper money. One must always remember in the end, it is not the true value of gold which changes, but rather that of the various paper currencies in which it is denominated. Now, going back in history, some 250 years ago, the brilliant French philosopher and writer Voltaire correctly analyzed the ultimate fate of paper currencies when he stated unequivocally that paper money eventually returns to its intrinsic value, zero. Now, absolutely nothing that has happened subsequently has refuted this observation, but we humans are nothing if not optimistic, and we keep trying to prove him wrong. In my opinion, our current global experiment represents yet another example of the ultimate futility of trying to sustain a totally unbacked fiat currency system. Now, the U.S., which has been providing the world reserve currency since the Bretton Woods conclave at the end of World War II, removed the gold backing from the dollar in August of 1971 because of their profligacy in the 1960s, funding Lyndon Johnson's infamous Guns and Butter program, which attempted to finance both aggressive new social programs and the Vietnam War simultaneously, resulted in an ever greater amount of U.S. dollars ending up in foreign hands. Under the formal arrangements of the day, only foreign central banks could turn in their excess dollars and be compensated with U.S. gold in return. And when this process accelerated sharply moving into the 70s, and U.S. gold reserves were being depleted at an alarming rate, then President Richard Nixon closed the gold window in August of 1971, formally launching the world into its latest escapade with pure unbacked fiat currency. Now, things actually got off to a rocky start, and John Budden alluded to it. As the decade of the 70s became increasingly inflationary and led to an increase in the price of gold from $35 in 1971 to $850 in less than a decade. To arrest this unwanted development and combat inflation, Fed Chairman Paul Volcker initiated a draconian monetary policy that saw U.S. interest rates rise into double digits, and while a recession followed, more importantly, the inflationary psychology which plagued the 70s was effectively crushed. Now, what happened next receives much less publicity, but in my mind is maybe of much greater importance. With the inflationary psychology effectively eliminated and a recession in full swing, Volcker then loosened the monetary policy and increased money supply, and it began flowing into financial assets with minimal impact on those everyday items which comprised the CPI. This was the beginning of the so-called era of disinflation. Now, as many of you no doubt remember, the bond market bottomed in mid-1981, and the U.S. stock market followed suit in 1982. Now, not surprisingly, with inflation muted and asset prices rising sharply, real return on financial assets were spectacular by any historical standard. Now, that made gold superfluous, and it lapsed into a 20-year bear market that saw it fall from $850 an ounce in 1980 to a low of $252 some 20 years later. However, Once the financial asset inflation took hold, it became a tough beast to control. The first real tremor occurred in 1987 with the stock market crash in October of that year. Now, it doesn't seem like much now with the Dow many, many multiples of what it was then. But if you were on the firing line, as I was as a stock manager in those days, it was truly terrifying, and I wondered for a few days if my job was coming to an end. Now, this event coincided with the advent of the Greenspan reign as Fed chairman. As an ally of Wall Street, he really initiated the era of central bank accommodation to shore up markets at the first sign of any serious trouble. Nevertheless, despite the increased monetary accommodation, CPI in the U.S. remains subdued, greatly aided by a significant new development in the world, the rise of China. China became a manufacturing giant. They increasingly flooded the world with cheap goods, and this was a huge factor in keeping consumer prices under control. But now the financial world was becoming increasingly addicted to essentially what was monetary heroin, and any new threat to markets was relentlessly addressed with ever more stimulus. The next episode culminated with the collapse of the tech bubble in 2000. In retrospect, I really believe that started us on the path to monetary ruin. The resulting extreme central bank ease found an outlet in the U.S. real estate markets, and we all know how that ended in 2007-8. Now, what was happening simultaneously on the debt front in many countries was, to put it mildly, dramatic. The U.S. was front and center in this development. When Ronald Reagan was inaugurated as U.S. president in January 1981, the U.S. federal funded debt stood at $960 billion, which had been accumulated over the better part of 200 years. Now, by the time of the real estate-driven crash of 2007-8, which, as you all know, threatened to take down the entire world financial structure, U.S.-funded federal debt was pushing $10 trillion. Now, a heroic effort by central banks globally to prevent a total collapse, with the U.S. Fed leading the way, resulted in massive quantitative easing programs everywhere, which is in reality just semantics for unlimited paper money creation. In the ensuing 8 years, the U.S. funded federal debt has virtually doubled to over $19 trillion, which is a mere 20 times as great as it was when the Reagan government took office. However, not to pile on, but the funded debt is merely the tip of the iceberg. Off-balance sheet federal debt funding like Fannie and Freddie, which are essentially bankrupt, combined with other misadventures, accounts for another $5 or $6 trillion in debt. But the real elephant in the room is unfunded liabilities. Now, when you look at sort of what's required in the future for Medicaid, Medicare, Social Security et al., and depending on one's assumptions, they are somewhere between $60 trillion and $150 trillion. In any case, a complete compilation of U.S. government liabilities would have them somewhere between $85 trillion on the low side to perhaps as much as $175 trillion. With U.S. GDP currently running somewhere in the $18 trillion per annum, the government's obligations are between 4.5 times and nearly 10 times GDP, depending on what numbers you use. Now, to say that this represents essential bankruptcy is a considerable understatement. However, because the U.S. currency remains the world's reserve currency, this charade has been allowed to continue. Now, I must admit that I have the urge to stifle laughing out loud when I hear someone refer to the U.S. dollar as the world's strongest currency. I love to quote Eric Sprott, who, as you know, will be speaking to you later. When we were at a conference together in Australia 7 years ago, he was asked by someone in the audience as to which currency he thought was the best. His response was a classic. He said that was akin to trying to identify the best-looking horse in the glue factory. And I can assure you, since he made that comment, the horses in the glue factory have become materially uglier. Now, I don't mean to signal out the U.S. specifically criticism. I was born there, and I've loved the United States for most of my life. But Something has gone seriously wrong. They're off on the wrong path financially, totally. And the implications of their actions for the world as a whole are disturbing, to put it politely. I believe that why many observers currently see the U.S. dollar as the best-looking horse in the glue factory says more about the travails of the currency blocks in the rest of the world. The U.S. dollar in reality isn't strong. It's just slightly less weak than the others. As you all know, Brexit was a major cause célèbre recently, but in my mind was just a smokescreen because the European Union was already doomed. One of the original major reasons for the Union was to prevent future military conflicts on the continent, an issue that seriously plagued the first half of the 20th century. To that extent, it has worked brilliantly. However, economically, it has been an unmitigated disaster. What Germany couldn't achieve militarily, they managed to accomplish economically by destroying both the economies and the finances of the southern European countries, Greece, Italy, Spain, Portugal, and to a growing extent even France. Now, with a monetary union with no firm fiscal restraints, German-influenced interest rates allowed the less fiscally responsible southern members to go on a debt-fueled spending binge, which ended in disaster for the southern countries, but perhaps more importantly, and ruined the entire European banking system. Ironically, the single entity in the entire European banking system with the greatest problem is none other than the German behemoth Deutsche Bank. They are ludicrously over-leveraged, loaded with the debt of essentially bankrupt southern European countries, and are carrying an almost unfathomable 50 trillion, roughly, in notional value in derivatives. How the powers that be sort this out is beyond my comprehension. However, that is just one of the many situations in the banking community of Europe that seems to be devoid of any palatable solution. For instance, the Italian banking crisis is very real, and it serves as a perfect demonstration of how blasé we have all become regarding absurd large numbers. We as a society seem to have been inured to them, literally drowning in cognitive dissonance. In a country of 60 million people, the Italian banks have accumulated an unconscionable 360 billion euro in non-performing loans. That represents roughly 20% of all loans outstanding in the country and works out to 6,000 euro for every breathing Italian citizen. Now that's preposterous to me. But what is perhaps even more laughable is the dispute between the mandarins of the European Union and the Italian government as to how to best address this. The EU wants the Italians to adhere to their rules and execute a bail-in where bank debt holders, depositors, etc., will be on the hook for some of the losses. The Italians want to resort to a government bailout because the bail-in procedure would cripple many Italian voters and be a catastrophic result for the government. Irrespective of how this is resolved, it is just another obvious manifestation of the depth of the rot in the world financial system. Now, switching to Asia, in Japan, the financial situation appears to be terminal. Funded government debt exceeds 250% of GDP, by far the highest ratio in the developed world, and the country, which is extremely xenophobic, has a shrinking, rapidly aging population. The Abe government, which in my opinion has been a total disaster, has consulted with the thoroughly discredited Ben Bernanke on the potential implementation of helicopter money. Helicopter money is just QE on steroids with no intermediaries between the government and the central bank, which then directly funds the government's deficits. The yen, I believe, is finished as a viable currency. Now, China, which I suspect will ultimately prevail because of their massive foreign reserves, their rapidly increasing gold position, and a very modern infrastructure, is still going to experience staggering problems in the intermediate term. A combination of infinitely too much debt in their system and huge overcapacity in virtually every sector of the economy is going to result in a very tough and lengthy adjustment period. Thus, the Chinese yuan isn't marching to the front of the currency line just yet. Now, what I have tried to describe is the terminal state of our current fiat currency system, with every currency of any significance dealing with problems beyond solutions other than further rampant money and debt creation. However, that is really no solution at all. It is akin to treating heroin addiction with ever greater amounts of heroin. The patient, just like our present currency system, will most assuredly die. However, there is one number which I think may capture the hopelessness of the current situation better than anything else. That pertains to the total amount of debt in the world today. As you all know, the system almost collapsed under a total global debt load of roughly $140 trillion in 2007. To combat the near collapse, the central bank's stimulus programs have fueled an increase of more than 50% in world debt in a mere 8 years. As a result, it is now in the neighborhood of $225 trillion. I don't even know who can count that high, but it is in that range. Now, this begs the obvious question of how has a debt load of this magnitude been sustained? Unquestionably, one of the major underpinnings has been the interest rate policy that started as ZIRP, zero interest rate policy, and has now morphed into NIRP, negative interest rate policy. I don't know how all of you feel about this, but in my mind, this has to be one of the most ridiculous developments in financial history. I place the whole episode in the whole category as tulip mania in Holland, the South Sea bubble, which originated in France, and the Japanese asset absurdity of the 1980s. I really believe Einstein was right when he said that the only thing he was positive was infinite in this world was human stupidity. And in my opinion, the current monetary situation is a prime example. Now, with regards to NIRP, there is now more than $15 trillion worth of paper which is trading at negative rates in the world. Thus, the holder of this paper is paying the issuer for the alleged privilege of holding this paper. This stupidity is compounded by the fact that I doubt any issuer will be in a position to redeem this paper without issuing even greater amounts of new paper. Things are so ludicrous that even the Canadian Imperial Bank of Commerce recently raised $1.5 billion in Europe at -9 beeps. Now, the case that I hopefully have been able to make is that our current iteration of paper money is doomed, and the only thing that remains to be settled is how long it takes before it devolves into hyperinflation, resulting in the total destruction of the money system that we've all grown accustomed to. One last point I would like to make before I deal with gold is that the vast majority of market participants today have experienced nothing but a world of financial asset inflation, and thus regard that as normalcy. It is most assuredly not, but it has been sustained far longer than the rational mind could have originally comprehended by what I refer to as financial innovation. With the advent over the last couple of decades of algorithms, high-frequency trading, the massive use of derivatives, etc., the financial asset bubble has been able to reach astounding levels, never before imagined. This is going to make the return to reality unbelievably painful and difficult, in my opinion. Now, to finally get to my subject of my talk, gold, which, as you all know, experienced the worst day it has had in 3 years yesterday, so this is timely. It is most assuredly one of the very best alternatives to this less than appealing outlook for all our various paper currencies. However, gold may be one of the most misunderstood subjects on the planet, and that is not by accident. The Western central banks, their various allies in the financial arena, and the mainstream media have been relentless in conducting a continual disinformation campaign to denigrate gold. It has been referred to as a barbarous relic, a useless commodity that has very little utility, a pet rock, etc., etc. It's nauseating, and it's most assuredly wrong. Now, this campaign has been waged continuously. As I said earlier, gold is fiat paper currency's worst enemy, and control of that pure paper currency system by the central banks confers unlimited power upon them. We know how that has turned out as the central banks and their confreres have made an unholy mess of things, which I have attempted to address in my earlier remarks. However, an incontrovertible reality is that gold represents real money and has done so for many centuries in many countries, and as a result of this fact, I believe gold is now on the cusp of its third spectacular bull market since 1971 due to the central bankers' follies. The 1970s bull market, as we said earlier, saw gold rise by nearly 25-fold from its starting price of $35 per ounce. The second bull market, which stretched from the turn of the current century until September 2011, saw a more modest 7.5-fold increase. But that was just the warm-up in my mind for what is coming. I have actually never believed that the most recent 5 years was anything but a deep correction and an ongoing bull market which will fully express itself when our present paper currency regime realizes its true intrinsic value, zero. Now, perhaps it may be worthwhile to provide the traditional definition of money. It is, 1, a medium of exchange, 2, a store of value, 3, a unit of account. The area where gold particularly stands out is as a store of value, because totally unlike paper money, it can't be relentlessly debased. In fact, its relative scarcity is its greatest attribute in this regard. Compared to the amount of gold currently above ground, the annual mine supply adds somewhere between 1.5% to 2% to the outstanding stock. This is very close to the annual growth of the world's population. Now, I certainly wouldn't suggest going back to the relative dark ages of money and using gold as the primary currency. However, to forestall the natural human tendency for excess and getting something for nothing, I strongly believe that the next global currency system, which is going to replace the current one in the not-too-distant future, is going to require gold backing in order to restore the public's confidence in their currency. Remarkably, some of the most stable, relatively inflation-free periods in recent history occurred when gold was an integral part of the global currency system, a fact that is not well advertised. Now, the argument that one immediately gets in response to this suggestion is there is an insufficient amount of gold in the world to back the enormous quantity of paper money and debt that is currently outstanding. However, that issue can be readily addressed when the inevitable currency reset occurs, and trust me, it's coming at us like a freight train. The price of gold can be revalued to provide the necessary backing. I would strongly recommend to all of you an interesting new book by the very bright and well-connected James Rickards entitled The New Case for Gold. In it, Rickards suggests that a minimum price for gold under the scenario I just suggested would be $10,000 per ounce and could be as high as $50,000 per ounce under certain circumstances. I am personally loath to use specific numbers, but I have maintained for a considerable period of time that when gold finally breaks out, it is going to trade at a minimum at several multiple of its current prices in all currencies. However, I must once again remind you, it won't be gold that is changing in value, but rather the rapidly debasing currencies in which it is denominated. Now, I recognize that this concept is probably very difficult for a lot of people to grasp because we have been operating under a pure fiat currency system for so long that it is hard to envision a totally different setup. I think, though, that it is worth noting that most pure fiat currency systems in history have seldom lasted beyond 40 years at best, and on that basis, this one is long in the tooth. However, my aforementioned comment on financial innovation perhaps helps to explain the longevity of the current system. We have, however, reached an absolutely unprecedented level of system leverage, and as a result, I believe we are close to a terminal state. Now, some of the U.S.'s main adversaries are acutely aware of this and have been acquiring as much physical gold as they can access at today's bargain prices. At the front of the line is China, which has well over $1 trillion worth of U.S. treasuries, and they are acutely aware of their vulnerability. Thus, they are accumulating as much gold as they can lay their hands on in a very non-transparent manner. They have recently announced official reserves of 1,658 tons, but analysts who track gold movements into China believe that the real number is at least 3 times that and maybe as much as 5 times larger than publicly acknowledged. The Russians are far more transparent, and they have been raising their reserves aggressively despite the constraints of their weak economy and Western sanctions. Russian reserves have grown nearly 50% in the last 3 years and now exceed 1,500 tons. Now, these are significant increases, and I think they reflect both financial and geopolitical motives. A former French finance minister, Valéry Giscard d'Estaing, coined the phrase, the U.S.'s exorbitant privilege of providing the world's reserve currency. He said that back in the 60s. And I think it has become clear to all and sundry that the U.S. has seriously abused that privilege. The response has been for their international adversaries, primarily China and Russia, to load up on gold because they know big changes are coming on the world currency scene, and having large stocks of the historical real money, gold, seems to be a good idea from their perspective. Now, somewhat ironically, longtime U.S. allies like Canada, Britain, and Australia now have little or no gold left in their monetary reserves. I suspect in the fullness of time, this will be seen as a serious error. Now, at this point, some of you may be wondering that given the unprecedented money creation and debt growth globally in the last few years, why has gold fallen so precipitously in price recently? Logic says it shouldn't have, because it represents the antithesis of paper money, which is undergoing serious central bank-driven debasement. Now, to be fair, even though staggering quantities of high-powered money have been created at the central bank level, the velocity of that money has virtually collapsed, which goes a long way to explaining the weak global economy and the absence of virulent inflation to date. However, that virulent inflation is on the way. However, when people fully grasp what's happening to their paper money, they will try to get rid of it, the velocity will pick up, and then you will see inflation mount very quickly. In addition, why gold has done poorly, the technicians amongst us felt that the dramatic price move from $252 per ounce from the bottom in 2000 to $1,900 in September 2011 had to undergo a significant correction. And as luck would have it, a perfect 50% correction of that advance was achieved when gold bottomed within the last year at $1,050 per ounce. However, there has been another important factor which gets considerably less attention, and that is the subject of so-called paper gold. This consists of futures trading on the COMEX in America, the massive transactions in unallocated gold in the LBMA in London, a proliferation of ETFs, pooled gold accounts, unallocated accounts in the Western banking system, etc. This has essentially permitted the unrestrained selling of various paper gold products with little or no physical gold backing. Even system apologists like Jeff Christian of CPM Group admit there may be as many as 100 paper claims in every available physical ounce in the Western system. Others actually believe the number may be as high as 300 paper claims. Well, it doesn't make any difference. I would suggest that this has been a classic Ponzi scheme which will be revealed for all to see when the Western world finally runs out of physical bullion. Nevertheless, what it has done is provide a wonderful opportunity to buy whatever physical gold is still available at a bargain price. Now, I would strongly suggest that anybody in the room that owns a paper gold product carefully investigate whether your vehicle is fully backed or not. I can say with assurance that Sprott Physical Gold Trust, in which I have a considerable personal investment, is one of the few paper gold products that can document that every ounce backing the trust is secured in a safe vault and regularly audited. The fact that we are gathered today with the Royal Canadian Mint that acts as our custodian should only increase your confidence on that issue. So, in closing, I believe we are approaching a period when arguably the greatest wealth transfer in human history is going to occur. Those owning real assets will prosper, while those in paper assets will be the loser. Gold is a real monetary asset, is right at the front of the line, but silver in my mind is even better. However, my topic today was gold, and silver is a subject for another day, and as I said, I love silver. Thanks very much for listening. It's been my pleasure.
An addendum. Could you talk to us about shares? Certainly the experience in the 1970s was pretty good for a lot of people who are in shares and differentiate the volatility and the risk and the potential for owning shares as a complement to a holding of physical gold bullion?
That's a very good question, John. I mean, I've always seen shares as a trading vehicle with much more leverage in the right environment. And I think the core position in a portfolio would be your bullion. In my mind, it has to be in physical form or in a very safe paper vehicle. But when the gold price starts to move appreciably, the gold shares go nuts for the very simple reason that the bottom line earnings are so levered. And I think the gold shares moved off the bottom. They bottomed in January the 19th, and they moved up 180% in 5 months, and they've just undergone a fairly significant correction of about 30% as measured by the Huey index. But I think that I would be a very big buyer of gold shares at this point because I still think they're undervalued in relation to the bullion in a historical sense. And if I'm correct on bullion, I mean, the money that will be made in some of these shares is going to be astronomical, and I think it's an important